welcome to today's Conquer Risk podcast. My name's Jeff. I've got my business partner Manish here with me, and something that came to light in our own circumstance, and this is a common discussion with advisors that I have anyway, which is, would you loan someone $10,000 for $8? Right? I mean, that sounds like a funny question, maybe, but ultimately, that's what thousands and thousands, in fact, millions of clients are doing on a daily basis. They're investing their regular cash in local banks, maybe a national bank, and many of them are paying you $8 on 10 grand. So that was the basis for this podcast, and we're going to talk through some of that, some of the brick and mortar stuff, online institutions, and ultimately, Manish, you're the one that pushed me to get out of regular banks and move to an online format.
Yeah,
what was your big push?
I don't really quite understand why anyone has a bank at this point. It's been 10 years for me where I just didn't see the point. You have these online checking and savings accounts, or the other term is cash management, which allows you to juice up the money market. And we can talk about that later on. But yeah, no, I mean, we had talked about this where you had a local bank or a credit union, and we just had some back and forth conversation where I was trying to get to the bottom of what you actually need it for. Why do you need a bank at all? So let me ask you that as, prior to us having that conversation, if we had to read this all over again, why did you have a bank?
Yeah. So, like anything, right? You start with your own experiences. And I remember very fondly, my dad worked at Goodyear, and my first bank account of any kind was actually a credit union. And his statement to me was, it's smart to have a bank and a credit union. Your credit union gives you some special, there's just some different, definitely differences between them, right? But whether you like one or another, that's a whole nother, so we can make a whole podcast out of that. But the end result was I worked for a couple of banks right out of college before I got in the investment industry. And I've just always had this, I'm going to call it tactile, this physical money, right? I'm nutty about making sure there's no crinkles in my bills and my wallet. I want to have a physical bank. I liked going into the bank when I needed to do something or get whatever. And, the reality is this all came to light a few years ago. I had a big business deal that came through, and I had a very large check come in. It was FedExed to the home. I was on a business trip. My wife, took some time off from work to go to the local bank that we had an account, and it was too big. They wouldn't accept it. What? You have a check to someone who has no bounce.
Let's back up a second. Why do you want a bank? It's because you think that the money is behind their safe?
It was I mean, there's just, for whatever reason, right? It was this emotional connection to think that you had to have a bank. It's the way it always, all right, I know you hate this phrase, right? But you do something because that's the way it's always been done. That is the worst excuse on the planet to ever do anything. I don't care if it's how you make a peanut butter sandwich.
For any future Potomac employees, that's the one thing that will cause the end of your tenure. I mean, it's the absolute worst answer. And maybe that's the case. I mean, we all grew up on, going to the bank and depositing your money and not having this online option. And, custodians and different sources are coming out with this that make banks irrelevant. And, which we're going to get to right now, the interest rate,
right?
And how that really affects it.
Right. And that's something that I think people, regular folks and even professionals often, I don't want to use the word confused, but they just don't understand the difference between an interest rate and a dollar amount, right? And it's fun to play games, right, with interest rates, because you can say, oh, well, you get 75 basis points or 0.75% versus 1%. Is that a big deal? Oh, look, we're getting an extra 2.1% instead of 2. Well, turn that into dollars, and that's the basis for the title of this podcast. Right? The Investopedia in May of 19, I was looking for something else and came across this. The average national bank savings account interest rate was 0.08% as of September 24th of 2018. And this is from the FDIC that was referenced on Investopedia. And the point is, 0.08, okay, that doesn't sound like much. That's $8 on 10 grand. Now I'm going to ask you, would you loan anybody $10,000 if you're going to get $8 in interest?
Well, I have something better for you.
Yeah.
With inflation, they're actually charging you money.
Well, there's a lot of ways that
So we need
people
to change
lose
the
money on
title.
the deal. Yeah, good point. All right, so so my issue is, are there other ways? And that was, like I said, we've already talked about a couple of things that came to light for me. I was like, okay, I need to rethink this process, right? So is 2% a better rate? Well, yeah, it is. What's that really mean? Okay, that's $200 on 10,000. So is that a lot? No, it's not. But it sure beats the hell out of $8, right? So what's it take to get $200? Well, look, there are a lot of online institutions that may be hooked to a brokerage, custodian, that sort of thing, may not, but at least that's something, right? You're getting something for your money, because $8, frankly, that's not even worth the time to blink or write down a transaction. Look,
Well, I mean, any money market fund. I mean,
Right.
at the end of last year, the 10-year was at 10%, 3%, give or take. And we've declined since then, but there are money markets that are paying 2 to 3%, probably
Right.
less now. And so, yes, it's not a quote unquote checking. And what I learned is that in order to call yourself a checking or a savings account, you have to go through certain bank regulations, which is why a money market is not a checking account.
Right.
A cash management account that uses money market, it's not a checking account. So there's some lack of SIPC protection, things like that. I don't know. If we get into a situation where SIP protection comes into play, you may have a bigger problem than the spread on the interest rate there. I'm not saying it's not something you should pay attention to. I've never personally, paid attention to that. I mean, most money markets are completely liquid. And if you're looking at the larger money markets, I don't think you're going to run into any issues of bucking the dollar and going below it. It's not financial advice, of course.
Right. Well, there's also a reality, which is most people aren't going to put in $250,000 into their savings account and hit the maximum FDIC insurance mark, right? I mean, the SIPC on the brokerage side is definitely a little bit different deal. There's some different limits there.
So what the hell's the difference between FDIC and SIPC?
Well, SIPC is for brokerage accounts for fraud that causes a loss. FDIC is for banking institutions primarily. But here's something that most people don't know, and this did come to light in the Great Recession, right? 2008, et cetera, is FDIC, they have offered, again, whole nother topic, but they have offered protection on a large volume of assets beyond just your traditional checking and savings accounts and CDs and so forth. So, I mean, there were some alternative products that were starting to be offered that had FDIC protection. There was some exotic stuff that was starting to get FDIC, and that was a real concern for me, because ultimately, look, if I'm going to have some institution that's going to guarantee my dollar for dollar for a fraud circumstance, then I want to make sure that they've got the right backing and that they're only going after those assets that are going to be legitimately able to be backed. Otherwise, you end up with, just like the mortgage credit crap that, S&P and Moody's, and there were all kinds of quote guarantees on some of those things.
Dewey, I don't know enough about this stuff. Like, it's like the credit card deal when you rent cars. Like, they say they cover you, right? You're never going to really find out until you actually get in an accident and see what the details are. Who knows what I don't know.
Yeah.
I haven't paid. I mean, I think, but anyway, moving on. I mean, one of the things that I had recommended to you was to use a cash management account. And the difference between cash management and checking comes down to their ability to up the yield by buying and selling treasuries and, using that within the money market. So I was at Fidelity at the time, still am. It was called My Smart Cash account, which we'll link in the show notes. And, you can't call it a check-in. Once again, it's a cash management account. And so the pros are, ATMs, they cover the fee. So you can use nationwide ATMs. They have the ability to transfer money back and forth to your stock account, which most do at this point. You get a debit card. The only real con is you can't really deposit or pull out tons of cash, which for most of us, we're not walking around with that kind of money. Maybe when you're hitting up to the casinos, you might need a little bit more than the $400 limit. But that's really the only con that I've personally witnessed, is the inability to pull out a lot of cash, which frankly is probably more of a pro in certain situations.
Yeah.
But that I can't think of anything else really.
Yeah, that's. I'll just say that we've found it enjoyable that we don't have to pay fees when we pull money out when we stop by a casino that we weren't intending to be going to. So all of a sudden we need some cash, and I have yet to find an ATM that I couldn't use, and knowing that there aren't any fees, I mean that's a good deal. So one of the things I thought was interesting, and this is again going back to that question of 10,000, would you loan somebody 10 grand for $8? What I think is interesting is if you start doing some research, if you're not careful on, like where the best, okay, so I'm going to go online. Well, where's the best online, right, account, a cash management account or whatever you want to call it? You have to really look at those details too. I mean, you can't just be a dumb consumer. You have to be a smart consumer, because ultimately, a lot of times they'll offer a nice rate. Maybe it's 2.5 or 2.25 or something right now. That's all relative, right, to the environment we're in. But if you get below a certain balance, well, then, that definitely changes. Or maybe it's a promotional rate, right? And what I find interesting is that sometimes some of those same companies that will offer, you're going to get 2.25% as an example, instead of what we talked about, the 0.08. Well, if you drop below $500, saw one, you drop below $500, well, then all of a sudden there's a monthly charge for the account. Well, if you do the math and work backwards, the monthly charge on $500 equates to almost a 10% cost. So you're seriously looking to pay me 2%, but if I get below that balance, I have to pay you 10. Yeah. I mean, I can see why they're offering a little bit more, right? So you can't be a dumb consumer. You have to be smart. You have to look at the little details, but there's just a lot more to be had. And it's really nice to have the online capabilities. Most banks do have online capabilities, but let's face it, I gave up on banks. You win. You won the argument. Yeah. I am now all online.
Well, listen, I mean, if we take it back to sort of the advisor community and what Robinhood came out with at the end of last year, it was a marketing snafu, but they came out and sold it as a 3% checking. They got into some hot water with the regulators because you, once again, cannot call something checking and savings without going through a bank regulation process. And so they abandoned it, which for them, actually, it turned out really well, because at the time they were offering 3%, 10 years were paying a little less, and they were either going to cover the loss, or I don't know the details, but that's what was talked about, is them just covering the loss. They would be in a world of trouble right now if they were still guaranteeing 3%. With the 10-year at 2%, unless they're coming up with other mechanisms that make the difference up. So, you got to read the details. You got to make sure that you're not jumping into something that guarantees a certain rate. And chasing yield is a bad thing. I mean, even from the investment side, right? Chasing high yield, chasing things that are paying much higher than the standard rate. There's usually a reason for that. And so that, once again, the devil's in the details with a lot of those things.
Well, that's a good segue to the fact that, look, when you're, the chasing rate concept, again, everybody is advertising based on a percentage. So should I chase rate because I was at, 2% and now I can get 2.25? Well, again, convert it to dollars and it starts to make more sense. On $10,000, you're talking about $200 versus $225 a year. Was it worth your $25 to move all of any automated transactions, move the money, take the time? Time is so valuable. Don't waste time trying to chase rates. But there's a huge difference between 0.08 and 2, right? I mean, that math does make sense. But once you get into the ballpark of what's reasonable, and that's what's funny right now in our interest rate environment, to me, the 10-year Treasury is less than what I'm making on my money market account online.
Is it?
Yeah. I mean, I think that's a little crazy.
What are you making on your money market account?
I'm getting about 220, I think it was. And what was the 10? When I looked at the 10-year, it was 2.0 handle. But I haven't looked in a few days. But anyway, it's just one of those things that even to be close blows my mind, right? I mean, that's something that I've got a government money market mutual fund that I'm using for the money market account. And, that's getting let's just call it an equivalent rate. Let's call it an equivalent. It's close enough to be.
Lag. Yeah. That just might be a lag. I mean, if you look at the 7-day SEC yield on some of these money markets, I mean, they're, they somewhat track. Yeah, they somewhat track the 10-year. I mean, I know on the Fidelity one, it's like 2.08. And yesterday the 10-year was at 2.07.
Right.
And it just could be a lag, but regardless.
But again, the point is you're at least close, and you're at least close. And honestly, that's still a better rate than go look at your local bank at your 1-year CD where you have to lock it up and lose interest if you take it out. Right. I mean, unless it happens to be a bonus rate, it's worth the effort. So
For
moving
full
on.
disclosure, because we are a regulated firm, for full disclosure, money markets can fluctuate. There's no guarantee you're going to get $1 back. Be aware, read the details, and I think I did my duty.
There you go. Good job. You win. You get a cookie. All right. So you've got a. I guess it's time for some recommendations. You've got a report that you read that you wanted to talk about.
Yeah. So pay to play was an article that Barron's did that sort of uncovered the pay to play among mutual funds at custodians, and the average client would probably never know this, and frankly, some advisors probably don't know this either. When you go to a custodian like a Fidelity or a TD, they give you free trades. You don't have to pay for statements, free logins. They obviously have to make money somehow. And one of the biggest ways, besides the spread on cash, is the mutual funds that pay them, right? So to get on platforms, you have to pay anywhere from 35 to 45 basis points to the custodians. And think about that. If a mutual fund charges, a percent, 40% of that is possibly going to the custodian to be on the platform, right? And that's the pay to play. And the article went into how, larger firms have the advantage, right? I think something like the top 10 firms control 2/3 of market share at this point. And smaller firms that may have a great track record and may be the best fund available can't get on the platform because they can't cut the check. Now, you and I know, we've been in this industry long enough that pay to play is sort of a weird term to use. I mean, if you're going to a conference and you can afford it, you're going to get in front of more people. Is that necessarily pay to play? To me, it comes down to the disclosure of it, right? You don't want to promote these 10 funds because, quote unquote, you think they're the best, when really it's only because they're paying you the most.
Right.
So it was an interesting article. I know, you're given your role at a broker dealer. And historically, they have been the worst offenders of pay to play. What are your two thoughts on this?
Yeah, I mean, ultimately, part of it is disclosure, but part of it is just an understanding. I think the fact that I would agree, most advisors don't realize all of the back end that happens in many cases to be on a platform. And that is true not only for mutual funds and ETFs, but also in some cases for third-party managers, right? That also may be the case, or for a REIT or et cetera, right? They're paying. And certainly when it comes to conferences, that is the deal. There are some hefty price tags. Most broker-dealers make a lot of money on their conferences because they're making all the vendors pay a hefty price in order to be there. And there's really no reason for an advisor to think through it unless they want to understand who is being pushed or marketed to. Again, it doesn't always mean that firm is the best. It just means that they are available. And there's.
But to your point, sorry to interrupt, but it's not just financial firms, right? You go to pharmaceutical firms, tech conferences. If you want to have eyes on your product, you got to pay sometimes to go to these conferences. And so this is the sort of give and take where sometimes pay to play is a bad term because, you're paying to go to a conference to get in front of people. It doesn't guarantee that money comes to you. Versus if a firm promotes a certain firm, without telling people that, hey, these guys are also lining our pockets. And I think that's the major distinction. But to the point of the article, the custodians aren't necessarily telling clients, because custodians aren't fiduciaries, that, hey, these 10 funds, they're paying us a certain amount. Right?
Yeah. And ultimately, this is funny because this is where the reality is, this is where it comes back. Does it cost the client more? Well, look, if the custodians were all saying, okay, well, anybody who has done gone through their checks and balances and met their criteria and so forth can be on the platform, and there wasn't this revenue share on the back end, then the mutual fund may not have to charge a 1. Maybe they'll charge a 60.
Then the custodians will probably just charge the client then 20 or 30 basis points.
They'll start charging them for ticket charges.
For free. I mean, enough
absolutely.
Already. You cannot you sign up. You have online access, money movement, the ability to purchase ETFs for free, the ability to conduct business, get statements. They used to charge you for all that shit back in the day. And now it's all quote unquote free. I mean, they have to get paid somehow. And so the solution to me has always been the right thing to do is always the right thing to do. So if you're getting basis points as a revenue share, just fully disclose that and let the chips fall where they may. But if let's say we get rid of that, then the custodians, and I think that's going to happen regardless. I think custodians will in the future charge asset-based pricing. So anyone that comes to that custodian will have to pay 20 or 30 basis points. And that's as above board as you can make it. But then we'll have a second round of bitching and complaining about why I'm paying 20 or 30 basis points. But it's a service. A custodian is providing a service, and they have to get paid.
Absolutely. Well, yeah, it's all about the compensation. So it's got to be there in some form or fashion, and it's just whether or not the clients or the advisors actually see it. And frankly, sometimes they prefer not to see it, and so you could bury a whole bucket load, and the world would be happy. Stick your head in the sand and call it a day. So
and we had our SEC audit recently, and it came up, and it was just a matter of disclosure, right? And we have always disclosed, and that should be kind of a standard practice among people to just disclose those separate payments and what they're for.
Right.
But my 2 cents, but.
All right, so moving on. So I'm going to give a little bit different recommendation. It's and this is wasn't a recommendation, but here's my recommendation. And this is something that goes beyond just the actual food, right? Flamin' Hot Cheetos. I'd never tried them, but I came across a story that I wanted to relay.
I have to stop you. This is now the second week in a row that you're recommending food, so you might want to keep that in mind.
All right. Well, see, here's the point, though. The food is okay, but I'm actually recommending the story.
The story,
right?
Okay,
but if you haven't tried I couldn't recommend that. Once I read the story, I couldn't recommend the story without actually going to the store and buying a stupid pack of Flamin' Hot Cheetos. So yeah,
So you actually bought it and ate it?
Yeah.
Okay.
Yeah. Yeah, they're tasty, but they're messy as all get out. Now, I live in an RV, and when you live full-time in an RV, you want to stay as far away from bugs as you can. So the last thing I want to do is eat anything that I have all over my fingers that dust is flying everywhere and is food for bugs. So, I'm probably not going to buy any more, but the story is worth the read. And apparently, they're getting ready to, there's been some contracts to make a movie out of this. Richard Montañez. He is the person who founded or created Flamin' Hot Cheetos. And I think it's pretty wild. It's an interesting story because of the fact that, first and foremost, he was the janitor.
Yeah.
Think about that for a second.
Janitor where?
He was the janitor for Frito-Lay.
Okay.
Right? So he made he took these regular Cheetos. And this has been, I don't know, off the top of my head, 20 years ago or whatever, right? And he realized as he was doing something else that ultimately there wasn't anything sort of hot and spicy from the company. And the CEO at the time made the reference in one of their meetings about the fact that every employee in this company needs to treat it as their own company. What would you do? And obviously I won't blow the rest of the story, but definitely read it. We'll provide a link in the show notes for sure.
Okay.
And maybe they will get all the way through to a movie. But here's a quote that I love. Somebody asked him, because he now actually teaches at a university, as well as part of his job description or job responsibilities. And apparently a student one day asked him, "Why are you teaching a master's program? You don't have a PhD." He said, and I quote, "I'm poor, hungry, and I have just now blown that." Wow. Okay, that's great. So I guess we'll get to cut this out. I have just totally blanked on that. So for the first time, we get to cut a little section out, and maybe this will be
we're keeping it
blooper later. All right, we'll see.
All right. Moving on from your recommendation now, I have. So for the longest time, I have
poor,
felt
hungry,
that,
and determined. I got it. Poor, hungry, and determined. Right. There you go. That's his PhD. So see, look, we don't mind making fools of ourselves. That's just the way it goes. That's what happens when you stick something in the brain, and then you stick a bunch of other stuff in the brain. So moving on.
All right. So, one of my recommendation for the week is a Netflix documentary. So for the longest time, I've felt that I've wanted to cut back on the amount of meat and dairy that I eat.
No, I can't do that.
No quite reason why. I mean, obviously there's studies out there. And so this was in my mind for a while. And then I watched this documentary called What the Health, which is a documentary about going plant-based and the damages that meat and dairy cause your body and the environment. shocking stats that a burger takes 660 gallons of water to produce. Now, I know you don't give a shit about this being from the Midwest, but nonetheless, these facts are true. And, climate change, if, that's the number one thing that you can do to get rid of climate change is the production of livestock. It doesn't matter how many cars you take off the road, a little bit, but not as much as livestock, right? Anyway, the point is, Forks Over Knives was the sort of, I guess, company that put this on or sponsored it. And so it was an interesting documentary, definitely worthwhile for, the health crisis. I think it is a crisis, what's going on in this country, and us fully participating in this crisis. And so, yes, I've been fully plant-based for 11 days. It feels like 11 years, frankly. I'm running out of things to eat, but since, Paige doesn't really eat meat anyway, so it's been challenging. I can't report back on any changes, frankly. It's only been 11 days, for crying out loud. But it's a good documentary, but it if you love meat, it will gross you out. So you may not want to watch it.
But I don't know.
I think it's pretty telling. It's on Netflix, and we'll put the link in the show notes. It's called What the Health. I recommend everyone watch it.
Well, yeah. Who knows? I mean, it may make me hungry. In the Midwest, man, the thought of not eating a steak or a burger is,
and then you're gonna dip
some little
Cheetos
piggies
and cookie butter.
There you go. Get some little piggies. It's a beautiful thing, man. You can't take away barbecue. All right.
What else you got? Anything else?
No, that'll do it for this week. I mean, ultimately, I think would you loan somebody $10,000 for $8? I think we've blown that one out of the water. It's time to look for another solution for sure. It's another good topic to talk to your clients about. But if you like this, definitely hit the like button, subscribe. You can get us again. I always like to hit this. We're on iTunes, we're on Google Play, we're on Spotify, Pippa. You can go to our YouTube channel and see us there. We offer the blog reference link to the podcast on our own blog page on Potomac.com, thepotomacfund.com. Apparently, I'm having trouble speaking today.
All right,
so
let's end
on that
it.
note, let's end it. Adios, folks. We're out.
See ya.
Peace.